Tomorrow is going to be a big day. We're going to go over it. What's in that crystal ball for the Fed and what is their outcome? All next on Real Estate Daily. Yes, that huge article. And we're going over some other articles. How is the home buying process in California? Is people buying? They're not buying? And of course, what is the debt doing to the housing market? We're going over all that today, all on Real Estate Daily. Welcome, everyone. My name is Troy, and every day we go over the latest news in real estate, housing, and the mortgage market. Now, before we jump into it, do me a favor, hit that like button. Really important for the analytics here on YouTube. They don't like me. I don't like them. It's not a good marriage, but we can't break up. You know how it is. There's kids involved and whatever. All right, let's jump right into this Kobesi letter. It is, yes, I know, you guys are like, Troy again, Kobesi letter. Guys, it's a great follow on Twitter. You want, or X, you want to know what's happening right now. You want the real numbers. You don't want to listen to that fakes, media BS. Here it is. Tomorrow's the biggest day of the month as we kick off September Fed meeting. Interest rate decision at 2 p.m. Eastern time. Right here, it's at what noon? That's at 11 a.m. Says no rate hike expected. So the actual, the percentage of rate hike that might happen is 1%. We have a 99%, hey, everything's flat. Now, we also know that in the last 2 or 3 times the Fed's come out, once in Jackson Hole last month and again before that, they came out kind of iffy, like, oh, I'm not sure what's going on or what's happening. But we've also seen the issue, of course, recently, we've seen a surge in, fuel costs, which then as fuel cost goes, it means, food cost goes up, everything goes up around it. And of course, this is because the Saudis and Russians and several other countries said we're cutting back oil production. And we don't here in the United States want to be self-sufficient because we want to cut off our own pipeline that happened a couple years ago. But it says, be sure to, okay, it says, we will be covering it in real time in depth summaries and analysis. The Fed meeting sets the tone into the year in. And yes, it does. If they're gonna come out after a decision and have that news conference with Jerome Powell, he's going to tell you that, which is the most important moment, what they still see for the future to the end of the year. And if it is bad, it's going to send the markets down. Stock market, NASDAQ, the crypto markets are all going to crash because they're all just expecting nothing to happen, a big nothing burger tomorrow. But I always say it's not what they do, it's what they say afterwards. All right, let's jump to the Orange County Register here. It says California home buying pace plunges 32% to a record low. This breaks the previous low set in the middle of the Great Recession in April 2008. Think about it. Nobody's selling their home. Nobody wants to buy at these high interest rates. So we have all this, there's not even a target. There's nothing going on in between. So because of that, and let's go look at this chart, which is insane right here. We are looking at is anyone really, buying homes? Okay. Nope, none there. This is important to note that when people come up to me and they say at a barbecue or wherever, Troy, when is the best time to buy a home? I say it's now. Why? Because if we get lower interest rates, everybody's going to come to this market and they're going to buy homes up and we're going straight to the moon. No question about it. But when interest rates are high, that's when you can find those good deals out there because you have less buyers. Even though we have less inventory, that makes more sense. There's less competition. I'll tell you now, if interest rates hit 4.5 tomorrow, you will not be able to get one home without 10 offers on it. That's a problem, and you're going to be competing and paying way over asking. Why not buy it today? Why not look today and suck it up? There's a 2-1 buy down that's out there that some of the lenders are actually offering. That means they'll buy down the rate 2 points down. That means you get rates in the 5s, right, for the first year. After that, we're going to probably see the Fed pivot and then start lowering rates. Well, then we're going to see a complete plunge in the actual interest rate. Would I rather have a home and then refi it, or would I rather have a home, have a lower interest rate, but then go up against 10, 20 offers and pay 10% over what the asking price is? You decide. All right, this is my girlfriend right here again. You know, I always tell you, if she's got her big fat face, you know, Diana Olick has it in the CNBC real estate window, you know everything's bad. But when she doesn't want to show her face, you know things are good. So this is Deutsche Bank, an analyst on the state of housing. He says prices should remain stable. Well, like I just said earlier, why should they remain stable? No inventory, no buyers, no bueno, right? So we're probably going to see just right here going flat for probably the next 2 or 3 months, maybe even to the end of the year, until the Fed decides they've had enough pain on our economy. All right. I'm going to go over another Kobesi letter tweet. It says, breaking 10-year note yield rises to 4.37%, the highest since 2007. That's 15 years ago. Rates continue to rise despite the Fed pause expected. Why? The U.S. is issuing record levels of Treasury bonds to fund deficit spending. You know, guys, we're spending $1 trillion a month. This is more money than we've ever spent before. And part of it, I think, is that the government continues to hire people, which then continues inflation going up, which continues our recession, which doesn't get anywhere. If you're paying wages that are just above minimum wage or even enough just for someone to survive, guess what they're doing? They're not going to go out and go to the club or do anything, but they're going to go pay for gas. They're going to pay for food. They're going to buy those essentials that keep going up on them. So it keeps them poor. This is what exactly is happening. There's so much supply that it's driving bond prices lower and treasury yields higher. Between this quarter and next, 1.9 trillion in US bonds will be issued. We're paying for deficit spending in many ways. Higher interest rates is one of them. Very interesting. Guys, give them a follow on Twitter or X, the Kobesi letter. You will not regret it. Now, if you guys have any questions or any comments, please leave them down below in the comment section. I have no problem answering it for you. If you think I'm a douchebag, just say I'm a douchebag. If you agree on some of the things, please have a take. Don't just say it for F's sake, right? Okay, let's jump into the interest rates here. Yes, another green day, which means it's bad, right? Red is good, means we're going down. Green is bad, going up. Even though we're seeing conventional basically flat and FHA just inching up, but still under 7%. What's really getting slaughtered is jumbo. It is going out of control. People don't want to take the risks. You know, big mortgage companies don't want to take the risks. And look at 15 conforming, man. I mean, come on. 6.66. I can pay off a 15-year loan and I have to pay 6.6. It's a much less riskier loan. It doesn't make any sense. It just keeps showing that, hey, again, like the Kobesi letter said, the more spending we do every month, that means they have to put out more bonds. The more bonds, we're just going to see them go up and up and up. Guys, thank you very much for joining me today. I really appreciate it. If you have any, again, real estate related questions, please leave them below. I'm more than happy to answer for them. Otherwise, you guys take care and pray for the Fed to not raise rates again tomorrow. We'll see ya.